Good morning, good afternoon, good evening, students, whenever you're watching this video. This is Mr. McRitchie, AP Macroeconomics. I am teaching you the final topic in my class in AP Macroeconomics, which is the foreign exchange market, the last graph for AP Macro. Here's the good news. I think, practically speaking, it might be the easiest graph. Out of any of our supply and demand graphs where there's like supply shifters and demand shifters, this one has the least things to memorize. It is also one of the more interesting ones because it's a thing that you don't think about. You learn a lot from this graph. You learn a lot from this PowerPoint. So pay close attention, guys. This is notes over the foreign exchange market, also referred to as the Forex market. All right, this is a good one. I make my head bigger on this one. All right. Foreign exchange and the Forex market. This is the same thing. It's just telling you I need to try and reset this so that I can not have that show up. And nope, okay, whatever. Leaving it, don't care. So, exchange rates. That's where we're going to start. We're going to start with other currencies. That's the main focus for this. So, let's make that'll fit perfectly. The exchange rate is the price of a domestic currency in terms of another currency. Effectively, it is how many of one currency it takes to get another, right? If you have ever been in another country, you've dealt with this issue, okay? Especially if you've done it recently, and I mean that not in the era of COVID. I mean that in the era of you being like a teenager who actually might have a wallet and money. If you were like 6, you probably don't have to worry about this. But if you were like 13, 14, and your mom was like, here, can you go get some soda, and you're in Mexico, and you don't have any pesos, it's real awkward. So the idea is that each country has different currencies, and their values are tied to each other, which is kind of crazy. It's this terrifying spider web of all of our currencies are sort of tied to each other. There are a couple that most currencies sort of relate to or base themselves around, namely the Swiss franc was that for a long time, and presently the most stable currency is, and get excited guys, it's the US dollar. Woohoo, we're doing it. So, we're the best currency around. Lots of countries have some store of dollars just in case things get wild. Now, doesn't mean they all use the US dollar. A lot of countries do, but not every country does. There are a number of countries that actually use US dollars. A lot of countries just call their currency the dollar, like Canada's, which gets confusing whenever you look at like a book and you're like, oh my god, US, it's $19, but in Canada it's $23. It's like, yeah, their currency is different conversion. Their salaries are different. Don't get freaked out. Whenever you go there, it doesn't make everything more expensive. It just means you have to convert to their currency. But there is a price to that, and this is the thing to be aware of off this first slide. Whenever you're converting dollars to another currency in another country, what you are actually doing is buying that currency. Like you go to the exchange rate booth, they tell you it's $1 per peso, which is not the exchange rate. That is not anywhere close to what the exchange rate is. They tell you it's $1 per pesos. You give them $50, they give you 50 pesos. That's not how that transaction went down. You paid them $50 for 50 pesos. It is an actual good you just bought. Okay, you bought a thing, the price was the exchange rate. And that price, just like the price of any other good or service, is variable. It can change, and it changes through supply and demand, and that's the graph we're learning about. But let's hear the practical reasons as to why this matters. So let's keep with that example. The exchange rate is $1 per peso. That just means it takes $1 to get a peso and a peso to get $1. Easy peasy, love the math there. Nothing is complicated there. That is never how easy it is in the real world with currency conversions. There's always 8 million decimal places, and it sucks. If that exchange rate were to change, which it does, not by this amount, that's insane, but it does change. Say it changed to $5 per peso. That would mean it now takes $5, why did I say 10? $5 to get a peso. So it used to be $1 per peso. It is now $5 per peso. The price of pesos has quintupled if you're an American. It now only takes 0.2 pesos to get $1. Effectively, 4 Mexican nickels would get them a US dollar. If they were to give 1 peso, they'd get back $5. Dang. So now, how that works practically is that the peso is now a more expensive currency for Americans. It is more valuable. It also means practically, and this is what we're going to get down to today, that Mexican goods are now more expensive for American consumers. That is obvious if you're a tourist. Like if you had gone to Mexico last year and it was a $1 per peso, you were like, easy peasy, I have $500 for the trip. I now have 500 pesos. I can exist as a person. Sick. But you go the next year, you've got $500 and are expecting the exchange rate to be the same, and it's not. And instead of getting 500 pesos back, you're only getting 100. Uh-oh. Oh boy. What? I can't buy as much stuff now. Correct. You're now functionally poorer because everything in Mexico is now more expensive to you than it was before because the currency value changed. And this is why today's lesson is crazy important, because if you don't keep an eye on exchange rates very carefully and you start traveling a bunch, you can be really wealthy in some countries and really flat freaking broke in other countries. And it's not based on the numbers. Like, a thing that students or people get very confused about is they'll see something like this, and this is a Japanese yen. It is an old Japanese yen. This is probably like 30, 40 years old. My dad gave this one to me. It's a 1,000 yen thing. You're like, holy crud, McRitchie, you've got $1,000 in your hand. It's like, no, I've got 1,000 yen. That's about $10. So don't get crazy thrown off by the numbers. It doesn't mean I'm rich in Japan either, necessarily, because the idea here is Japan, as a country, uses a base 100 system, not a base 1 when it comes to their currency. America uses a base 1, so we have the $1 bill as like our starting point, and we have coins below that, but those are decimals. Like a penny is 0.01 US dollars. A nickel is 0.05. A quarter is 0.25 US dollars. They're called cents, but they're a decimal point dollar. In Japan, they don't have any decimal point currency. They don't have 0.5 yen. They just have a 50 yen coin. Because the 100 is their 1. The 1,000 is their 10. The 500 is their 5. That's how they did the numbers, so they wouldn't have to use decimals. Which you're like, oh, that actually makes more sense. We have decimals, and that's weird. A quarter is a quarter of a dollar. It's like, yes, but also you could just have a $100 bill be our normal one, and then a $25 bill or $25 coin act as the quarter. Other countries use different systems, is what I'm telling you. So don't get like, I'm wealthy. It's like, the currency conversion rate and prices in that country will matter. So here's an example of what I mean by that, like, price thing. This is Japan. This is the yen, the exact currency I was talking about. This is the menu for McDonald's. This was as of, I want to say, 2014 is when I grabbed this menu. And there's your number one, your Big Mac. That's your Big Mac combo. 650 yen for the combo. 320 yen for just the Big Mac on its own. Cool, guys. That should look pretty familiar to you, because if I went to McDonald's now, it'd probably tell me that the Big Mac combo is something like $7.50. $7.50. Cool, I mentioned they use a base 1 instead. So, okay, that isn't actually insane. Sorry, if you're hearing counting, it's because I got my international wallet out, and my dad and myself have sort of pooled a bunch of random currencies in there that I can sort of show you. I'm trying to organize it because I had it just dumped out on my desk. Because I was like, what do I even have in here? And it's like, oh yeah, I've got 10 dirham, which is the UAE's, the United Arab Emirates currency. I've got that because my dad lived in Abu Dhabi for 5 years. So I got a bunch of those, things like that. So these will come up as practical examples in some questions. So what that exchange rate thing matters, how does this thing change? McRitchie, why am I poor in some countries and rich in others? Okay, it's a graph, yay! The reason it's a graph, well, at least the reason to show you how it works is a graph. The way I can show you how it works is a graph. So, the foreign exchange market, also referred to, and I will almost only refer to it as the Forex market, is the market for currencies. It's an international market. It is like the stock market, but more insane, because it is open 24/7. It is open all the time, and there's crazy transactions happening constantly of people who are just swapping different currencies around, chasing exchange rates, where they do like, $1 gets me 5 pesos, but 5 pesos gets me 17 yen, and 17 yen gets me $1.03, and big brain, and then you do that with a lot of money. Stuff like that. It is a supply and demand graph. The foreign exchange market, the graph, not foreign exchange market, the thing, is a graph with a quantity and a price. The quantity is the quantity of the currency we are talking about. So this is a graph where your axes are going to not be the most consistent. You'll have like quantity of US dollars if we're talking about the Forex market for dollars. If we're talking the Forex market for pesos, it'd be quantity of pesos. If we're talking Forex market for the dirham, which is the UAE's currency, it'd be quantity of dirham. So you're going to use whatever the currency we're talking about for the quantity, and the y-axis is the price of the currency, which will be an exchange rate. Because again, the exchange rate is the price of your currency in terms of another currency. So here's where the graph gets weird. Unlike most of our other graphs, this one has a partner. In that, whenever you're drawing a Forex market graph, you're really thinking of two of them. You're thinking of the Forex market graph for one currency, say dollars, and the Forex market for the other currency in the question that's been talked about, which could be like euros. So you have like the dollar graph and the euro graph. You've got quantity of dollars and quantity of euros. You've got euros per dollar and dollars per euro. That's where it gets tricky. So let's explain how the currency values change. Okay. The way the currency values change is if you want more of the currency. If you're trying to get more of another currency, if there's a greater demand for that currency, its value will rise. So how does that work? Well, the reason why you would want another currency has to do down to really two things. And that's the lovely part of this graph. There are two shifters. That's it for the entire graph. It's amazing. The two shifters are: you want to buy the goods or services of a foreign supplier. You want to import a good. That could be for a number of reasons. That could be like, I think French wine is delicious. I want to buy French wine. Okay, well, if you want to buy French wine, at the end of the day, the French winemaker doesn't want your cruddy American dollars with like old American dudes they don't know on it. It doesn't do anything for them. They can't go to their local bakery in, I'm just imagining literally the town from Beauty and the Beast because I'm trying not to think of Paris. So they're in just like their random nice little podunk town in France, which is just a beautiful village with great old buildings and stuff. They're going to go to the bakery. They can't use US dollars. They need the euro, which is France's currency. So whenever, it's a really long-winded way of saying, whenever you're buying a good from another country, at some point in the transaction, the currencies are being exchanged. At some point in the transaction of you buying this French wine, dollars are being converted to euro. So whenever you want to buy that French wine, you really, even though you don't know this, you really want French currency as part of that. Now, we've removed that burden from consumers because that would be a massive pain in the butt if every time I wanted to buy something from another country, I had to convert my currency myself. That'd be wildly inconvenient. But it does happen in every transaction. So it could be taste, it could be quality. That kind of can go hand in hand. But a good example would be like German cars, where German cars are seen as very high quality machines. They run really well, they're very powerful, they're very fast, they're very beautiful. BMW is a great example of that. Even Volkswagen on the cheap car scale is still pretty dang good. VW Beetles run forever. Okay, things like that. Relative price levels, that's a different thing. But remember that price level would be like inflation rate. So if price levels are really low in another country, meaning their prices are lower, their goods are cheaper, and we can go in and pounce on that. Okay, if we're experiencing a bunch of inflation, I might not want to buy American products because those American products are getting really expensive. But you know it's not getting expensive? The Canadian products that are right from there and aren't technically US dollar based. They're Canadian dollar based. So international goods get cheaper. Yeah, when inflation starts happening, it's the American goods that get more expensive, not necessarily the Japanese goods, because those don't care about inflation in America because it ain't their currency. The next one would be changes in relative wealth. That's usually tied to GDP. Like, if your country is doing super duper well, you're going to be buying more stuff, period, including stuff from other countries. So that's the thing to be aware of. Those were all under the idea of desire to buy goods and services of a foreign supplier. Now, these could be decreases too. You could have your country's doing really poorly, like you're in a recession, so you're importing less, so you're demanding less foreign currency, stuff like that. It can go left and right in these examples. I was giving you mostly positive ones. The second one, a relative change in interest rates that investors can earn. You're like, oh God, interest rates? It's like, yep, interest rates. So those old graphs from Unit 5 and Unit 4 are back to play again. Dang it. So interest rates. The idea being, if interest rates are really high in another country, that is actually good for me in America. Why? Well, I don't borrow from France. Like, if France has really... I'm sticking with France for some reason. Whatever. Germany. Germany has really high interest rates. I don't take out loans from Germany. No, I don't do that. But nothing's stopping me from buying like a German bond. A German company issues bonds same way an American company does. There's no rule saying I can't buy those. That interest rate's really good for that. No, there's a lot of countries allow us to put money in their banks, like a Swiss bank account. And that's the thing that people talk about a lot with rich people. It's like, yeah, because it's not here. So if they've got really high interest rates, then you're going to want to put your money in that country, namely in their banks, but you might be buying an asset from them too. Either way, you're going to want their currency, because just like an American, French winemaker doesn't want American dollars for their wine, a German bank wouldn't want American dollars for their bank. There's also a currency conversion state that happens there too. So the idea, and this is what I would write down for this second bullet, says a change in interest rates. The second bullet, the big idea for that is investors want to invest where there is a higher interest rate. Investors will want to invest where there is a higher interest rate. Now this might be confusing for the idea of investment spending and interest rates are inversely related, but those are different things, and this is super annoying, but investment spending is spending by businesses on themselves. When I say investors, I mean people like buying stocks and bonds and financial assets. The economics wording is so annoying. So interest rates, you're going to want to chase the high interest rate in the Forex market graph. Interest rates, this is like the one graph where high interest rates are good. Okay, so let's sort of practical example this. So here's our first practical example of a Forex market question. The question is, foreigners want the latest computer from Dell. And let's stick with euros. So let's say, why am I blanking on literally every country that uses the euro? Because I'm trying to say the UK, and the UK doesn't anymore. Those stupid British people. Let's stick with Germany because I just bashed them a little bit there. So let's say Germans want Dell computers. Don't know why they'd want particularly Dell computers, but Dell is an American company. So at some point in this transaction, they're going to need US dollars. So they're going to have to exchange more of their currency for dollars. Okay, let's think about practically how this works. So if I'm thinking dollars, what's happening for the dollar is that more people want the dollar. So if we're doing a supply and demand graph, that's for euros. I have this in the wrong order. Ignore that. That's spoilers. If I'm looking at the market for dollars, and this is an example of a Forex market, is that I have the exchange rate, which is technically speaking euro price per dollar or euros per dollar. This is what I would write on my y-axis, is euro price per dollar or euros per dollar. Quantity of dollars, supply and demand of dollars. Okay. Foreigners want more of an American product, so they want more dollars. They want more dollars. Demand for dollars is rising. Look at that beautiful animation. So the euro price per dollar is higher. The quantity of dollars being exchanged internationally is higher. So when it says quantity of dollars here, be aware this isn't like the money supply. This is the amount of dollars being swapped around overseas. This is the foreign exchange market for the dollar. So it's international we're talking about. So because foreigners want more dollars, the value of the dollar, the price of the dollar, will start to rise. It'll take more euros to get a dollar, and more dollars will be acquired overall. So we've got this higher overall price because of the higher demand. Well, what's happening for Europe? And that's the important thing for this, and spoilers, just saw it. But whenever you're doing a Forex market graph, you actually are picturing two graphs. The market for the two currencies being talked about. There was dollars, and there's the Germans that are demanding it. So, okay, Germans want more dollars. What do they have to do to get them with their euro? They've got euros. How do they get dollars? Well, they've got to start swapping, right? They've got to exchange. They've got to switch them out. How they're doing that is that they are putting more euros into the foreign exchange market. They are supplying. There is a greater willingness to supply euros in the foreign exchange. They're basically willing to give up more euros. So now there is a greater overall supply of euros in international transactions. More euros are being converted for other currencies. There is a larger overall supply of euros, therefore, in the foreign exchange market. Now, a thing to mention here, on my euro graph, where it's quantity of euros, my y-axis is flipped. It is dollar price per euro here. It's the amount of dollars it takes to get a euro. The way to think about this is the last thing here will be the same as your quantity. So it's like dollar per euro, quantity of euros. It was quantity of dollars, it was euros per dollar. So whatever is after the per, if you're writing it as a fraction, it'd be like dollars over euros. Whatever the denominator is the same as your x. So what does that all mean? So the dollar price per euro decreases and the euro price per dollar increases. Effectively, it takes more euros to get a dollar now because they wanted more dollars, so the value of the dollar goes up. That also makes it so that the value of the euro is going down relative to it. So it takes less dollars to get a euro and more euros to get a dollar because their value is based on each other. In practical vocabulary terms, it means the dollar has gotten up in value. The term for that is it's appreciated in value. Whenever you see the word appreciated, that means that its value internationally has gone up. Currency appreciating in value does not mean like inflation or deflation is happening within your economy. It means that your currency is worth more internationally. It's worth more in terms of other currencies. And what that practically means is Americans can now buy more goods from Germany, right? If it takes fewer dollars to get a euro, then every single good that is priced in euros, aka European goods, is now cheaper for us. Ooh, that's cool. We can buy more stuff. We just got richer internationally because foreigners wanted to buy cruddy Dell computers. Now this would be a very marginal increase. It would be very small, but if you're making large purchases, that could matter. If you're buying in bulk or buying large amounts of things, a difference of like 0.001, if you're spending hundreds of thousands of dollars, is actually in the thousands. So that matters. So if the price of the dollar rises relative to a foreign currency, the dollar has appreciated in value. Here's why that matters for the course. Because this affects imports and exports, aka net exports, aka aggregate demand. Ah, dang it. So if your currency appreciates, you're going to be buying more stuff internationally because your currency is worth more internationally. So you will be importing more. And, importantly, if your currency is worth more and their currency is worth less, they can't buy as much of your stuff now. So your exports will decrease. So when your currency appreciates, imports go up, exports go down. Logically, it's because your currency is worth more, so you can buy more foreign goods. However, your goods are now more expensive for everyone else. Oh, there's a trade-off. There's always a trade-off. There's always a gain and a loss. So the gain is we can import more. The loss is we can export less. So when your currency appreciates, it isn't exactly the best thing in the world because this is telling me that my net exports is going down, which hurts aggregate demand. So second example, and I'm using the example that I had. Okay, the one that I was talking about at the very beginning. Suppose Americans develop a taste for vintage wine produced and sold in France. So we're sticking with euros for this example. Go through this process. Think what happens on my dollar graph, what happens on my euro graph. Okay, what happens to the dollar, what happens to the euro if Americans want to buy a French thing. Okay, what happens to both of those graphs? What happens to the value of the currencies? Okay, the dollar becoming more or less valuable here. And if you can, think of how that affects imports and exports. So your checklist for this is, okay, what happens on my dollar graph and my euro graph? What happens to the value of the dollar and the value of the euro? And then as a result of that thing, what happens to imports and exports as a result? Now the starting point is already here in red. So, and I'm going to start doing the question now so you can pause if you want. So starting through this question, okay, if we want to buy a French good, we actually want the French currency. Again, that's the euro. So we are demanding more euros. We want French good, we want French currency, want demand. That sounds about right. So the demand for euros is going up. And if we want more of their currency, we have to give up more of ours. So we'll be supplying more dollars in the exchange. The supply there is your willingness to exchange the currency for other currencies. And if you want to buy more of another good from another country, you're going to want to exchange more of that currency. So on the market for dollars, my supply is growing because I am more willing to exchange dollars than before. This will lead to the value of the dollar going down. The euro price per dollar is lower. It'll take less euros to get a dollar now. Zoinks. If I'm looking at the euro graph, the demand is going up. So here's the nice thing with this graph that I can spoil for you right now, because there's two graphs technically. There's the one for each currency. what you're going to do with these two graphs is, on one, the demand will do a thing, on the other, the supply will do a thing, and they'll do the same thing. So demand goes up on one, supply goes up on the other. Supply went down on one, demand went down on the other. That's it. So if you're not sure on I'm not sure I get why supply is going up for dollars. It's like, okay, do you get that demand is going up for euros? Yes? Cool. Then if we want more euros, we have to be supplying more dollars to get them. We have to be giving up more of our currency. We're exchanging more. We have a larger overall willingness to swap. Think of supply as your desire to swap. We want to swap more. And we want more of theirs. Supply is going up for dollars. Demand is going up for euros. It's the same direction shift, just a different line. Now, in that case, the price of the euro went up and the price of the dollar went down, which would mean that the dollar has depreciated in value. That's the opposite of appreciating, depreciating. So if you're ever mad at a friend, you, instead of saying like I hate you or I dislike you, you can just say I depreciate you, because it's the opposite of appreciating somebody. Boom. Got you a new sick burn to never use in front of your friends without, because you'll be called a nerd. So the dollar has depreciated in value relative to the foreign currency, which means we can't buy as many foreign goods. We can't buy as much stuff from Europe and all of that. But it also means something kind of neat. Because if our currency is worth less, then all of our goods are cheaper for other countries. Well, that would mean that they can buy more of our stuff. Yeah. So when your currency depreciates, imports go down and exports go up. That's actually kind of good for our economy. If your currency gets lower in value, then that means we'll be buying less foreign goods and more people will be buying our own goods. That means money is flowing into our economy. That's helping our economy. So when the currency depreciates, it actually allows for more money to flow in. It is like bad for your American consumers for this to happen. Like if you're an American consumer and your currency is worth less, you can't buy as much stuff. You're poorer, that's bad. But if you're an American producer or the American economy as a whole, it's actually kind of good, because producers will be able to sell more of their stuff internationally and more money will be flowing into our economy at the end of the day. That's good to know. So if your currency appreciates, your net exports will fall. If your currency depreciates, your net exports will rise. Again, you can write down as many of the relationships as you want, but if you start doing that, it ends up being something along the lines of like 50 to 60 relationships in economics, which is kind of in just macro one. It's absolutely insane. You can look up like a Quizlet of it. I think I've seen it. It was like 50 questions. It's hilarious. And they're all different, so it's just the worst. The best thing to understand is the reasoning. Why, when your currency depreciates, would imports go down and exports go up? Well, if my currency is depreciating, it means it's worth less internationally. If my currency is worth less internationally, I can't buy as many foreign goods, because if my currency is worth less, I'm like poorer. So I can't buy as many foreign goods, which means imports are going down. But if my currency is worth less, then every single good that is priced in US dollars is now cheaper for everybody else. If it takes more dollars to get a euro, that means it takes less euros to get a dollar. Ooh. So people from Europe can buy more of our stuff, which means exports are rising. This unit really messes with the import-exports thing a ton, in case you can't tell. Okay, so that's with just that was just like desire to import. That was that shifter. Let's talk about the interest rate shifter now. So let's suppose that America's got higher interest rates than just about frickin' everybody. Let me check which country I have graphed here. Still euros, so we're going to stick with Europe. We're going to stick with Europe because the euro symbol is the easiest one for us to imagine and draw. If you don't know what the symbol for the euro is, it's this. Oh, it's covered. Sorry, it's that. That's the symbol for the euro. Or at least that's the simplified symbol. It's saying like a more fancy version, but I just do that, and that's fine. They tend to get it. So we have this international currency. We have this idea that our interest rates are higher than everywhere else. In terms of like, investment spending in America, that's a whole other question. The question here is what happens on the foreign exchange market if America has higher interest rates than, Come on, Gary. Ireland. Wait, which Ireland? The Republic of Ireland or Northern Ireland? The Republic of Ireland. Because Ireland is still a part of the EU. So we've got a higher interest rate than Ireland. Cool. What if I'm Irish, which my ancestry probably is based on the fact that I am. Checks my skin color. White. There's a good chance that I've got some Irish heritage in me. My mom's from South Africa, but my dad's from South Carolina, and my last name is McRitchie. It's a Mick, so we're in the wheelhouse of either being Scottish or Irish. So we got Irish heritage. Okay. If our interest rates are higher than Ireland, people from Ireland will want to do what? Americans got higher interest rates. What would I want to do? Well, I can go ahead if I'm in Ireland. I'm not going to do an Irish accent because it will be offensive and bad. And the same thing at the same time. If I'm from Ireland and America has a higher interest rate, I would kind of want to capitalize on that. Because there are cases in which interest rates are good. If I'm Irish, I'm not going to be taking a loan out from America. So like the downside of interest rates, which is that it's the price of a loan, that does not affect me literally at all as an Irishman. But if I'm Irish, then I could very easily do things like, well, I could buy a bond from the United States government because they're cool with foreign investors. Think of that, thing from last week where I showed us the government's debt. A good third of it is to foreign investors. So they're very cool with selling bonds to people overseas. So yeah, I could buy U.S. government bonds where a high interest rate is good. I collect more money off of that. I could put my money in a United States bank if they'll allow me to. And in that case, the high interest rate is freaking amazing because then my savings account will collect a bunch of interest. So here's the idea. Interest rates are good in the Forex market. If you're not from another country, that other country having high interest rates, you can capitalize on that. So foreigners, in this case, will want to invest in the United States because they get a higher rate of return on their investments, on things like a bond or their savings accounts. So they want to invest in America. That means they want US dollars. So if I'm thinking the graph, the dollar graph would be experiencing an increase in demand. In order to get the dollar, the Europeans have to do what? Increase their supply, Mr. McRitchie. Yeah, a person who's randomly saying that. Increase their supply. So market for euros. Supply is going up. They want more dollars. They're going to be exchanging more euros. They're pumping euros out into the currency conversion thing. They're throwing the euros into the currency conversion machine, imagining that they're at like Main Event or one of these dumb like places where you can go bowling and play arcade games and you're throwing all your money into that machine and it gives you like these tokens. Cool. They're supplying a bunch of euros, getting these US dollars they can put in the bank. They just don't actually have to do that step. That's the nice thing. So they're supplying more euros. The value of the euro is starting to fall. The dollar graph, the demand is going up because they want to invest in the United States. They want more dollars because they want to invest, which means our currency has appreciated in value. We had higher interest rates. Other people wanted to invest here. Our currency's worth more, which means what happens to imports and exports? Think. Currency's worth more. What happens to imports? What happens to exports? Currency's worth more, McRitchie. Yeah. So we're like richer internationally. Yeah, got it. So we can import more. Good. But our currency's worth more. So what happens to exports? I mean, they probably go down, but like, why? Our currency's worth more. Why would imports go down or exports go down? Oh, our goods are more expensive. If our currency is worth more, then everything that's US dollar price is harder to get. Yes! When your currency appreciates, imports up, exports down. So net exports as a whole, dropping like crazy. What does that do to my aggregate demand supply graph, guys? What does this change in my currency? What does the US dollar appreciating do to my aggregate demand and aggregate supply graph? It's based on this. The thing I just said, what happened to net exports. And what does that change in my aggregate demand supply graph? Let's think. Okay, average demand supply graph, SRASAD, my shifters, supply, ability to produce. This doesn't change my ability to produce things. It could if I was really thinking hard. Aggregate demand is our spending. When that's spending, imports and exports we're spending there. Net exports is a part of it. Oh, right, net exports is a part of aggregate demand. So if imports are going up and exports are going down, net exports are falling for us because we're buying more stuff internationally and less stuff is being bought from America. Oh, crud, that decreases aggregate demand. Aha. So when your currency appreciates, even though that sounds good, it actually causes your aggregate demand to go down because what's happening is your currency is worth more internationally. You're not demanding stuff from America then. You'd be demanding more from other countries and demanding less from America. Ooh, Nelly, that's tricky. Lots of other examples in this PowerPoint. If you want to pause, and I'll just slowly scroll and you can go through them, you can. But I had like 60 slides in this PowerPoint earlier today. I narrowed it down to like 30, but there's still a bunch of examples. So I'm going to sort of freeze frame on these. Feel free to like pause and check your work. So first example, higher interest rates in America are lower relative to the rest of the world. They don't want to invest here. Oh, I should actually explain this one. So if interest rates in America are lower, you could take this two ways in terms of solving it. You could say that Americans will want to invest more in other countries because that would mean that they have a higher interest rate. You can also say other countries would want to invest less in America. So there's actually two answers you could do. The first answer is if Americans want to invest in other countries. That's what I have drawn here. Which is if we want to invest in other countries, supply of dollars goes up, demand for the other currency goes down. You could, alternatively, I don't think I have this graphed in this PowerPoint. I don't think I do. You could alternatively say foreigners will want to invest less in America, which would mean there is a lower demand for dollars and a lower supply of the other currency. That is fine. You are actually allowed to do that. Because if you had a lower demand for dollars, just like having a higher supply of dollars, you'd get a lower exchange rate. Either way, they wouldn't care. You'd get a lower exchange rate. So if you're saying that we have a lower interest rate and people want to invest less in us, okay, you can draw demand decreasing instead. You'd still get the right answer when it comes to like appreciating and depreciating currency. And in that case, instead of demanding more euros, there would be like a decreased supply of euros because they're not exchanging as much of their currency. It would still get me a higher exchange rate, so we're fine. So there's more than one way to answer these sometimes. It's almost only the interest rate route can you answer them more than one way. Okay, just scrolling through these answers for this one. Pause. I'll just tell you. I'm not going to draw. I'm just going to tell you. Unpause. American goods are more expensive than German goods, so Americans would want to buy more German goods, or Germans would buy less American goods. If Americans want to buy more German goods, there would be a greater demand for euros, greater supply of dollars. There you go. Next one. We already done interest rates. This was a bell ringer for my class because I'm trying to do all this in one video as opposed to two videos for you guys. Japanese video games are popular with American children. Pause. Unpause. We would be demanding more yen because we'd want to buy these Japanese video games and supplying more dollars. You can't even, interest rates, already did that one. Japan, I've already done the demand thing. This is a good one. Japan's real GDP increases. Pause. Think about what that means for this graph. This one I'm actually going to fully explain. Not just like quickly do it. I'll do like medium speed. Unpause. Japan's real GDP increases. What does that mean? Okay, it means that Japan is producing more, making more money. Ooh, that's the big thing. Remember, when GDP goes up, income goes up. So Japan is more successful economically. So Japan will be doing what? Buying more. From who? From everyone. They're buying more from everybody, including us. So if their GDP starts to increase, they'll be spending more, including spending on us. So the demand for dollars, or really any other country they trade with, would start rising and the supply would go up on the yen graph. This is important because of things like recessions. Because if when your GDP starts doing well, you start buying more from other countries, then your GDP starts doing poorly, you're buying less. It's how recessions hit everyone. It's why recessions have become much more of an international thing than just oh, America's in a recession. Oh, boo-hoo, poor America. What losers. It's like, no. If we go into a recession, the world goes into a recession. Because if we're spending less, we're buying less from everybody. So they're exporting less to everybody else. And oh, no, that's bad. So when your GDP increases, you're buying more from other countries. Demand for the other country goes up. Supply of yours goes up. If it said GDP is decreasing or they're going into a recession, they'd be demanding fewer dollars and supplying less yen. Price level in Canada increases. This was the German price, American thing. I've already done that. Okay, last thing. Oh, I should mention, This is to make you feel better. There is no long-run Forex market. This is not a macro graph economically. It is a graph of a specific market, like how the money market was and how the loanable funds market was. So there wasn't like a LRSM or an LRSLF. Okay, there's no long run here, so. But there is one more thing we got to mention, and it's capital flow. So in all these examples, we were talking about like money moving from one country to the other. Well, that actually is an important thing to talk about. The idea of capital flow, which is the flow of financial capital, money, between countries. That when we start buying more goods from other countries, money is leaving our economy and going into theirs. That your country could be experiencing capital inflow, where money is flowing in, yeah, that tracks, from other countries, or outflow, where money is flowing out of your country towards other countries. Now, why that matters is because of a graph we have already covered, and that is the Loanable Funds Market graph. The Loanable Funds Market was based on the idea of how much money banks have in your economy and their ability and desire to loan out that money. That was the supply of loanable funds, was how easy it is for banks to loan out money. So, if the loanable funds market gets affected, if interest rates in America, if we have this capital flow in, say that we're buying more, say that other countries are buying more of our stuff and money is flowing into our economy, that money is at some stage going to end up in banks, right? It's going to end up in banks at some point in the transaction. There's more money coming into our economy. At some point, money is going to end up in a bank. Cool. So then the supply of loanable funds would be growing. One of the shifters of the supply of loanable funds was foreign investment. This is what I'm talking about. Foreign investment is capital flow. It is the flow of financial capital between countries. It's affected by your Forex graph. Whenever there's anything going on with international trade, it will affect the amount of money in other countries. So you can almost always do Forex market connect to loanable funds market. And I already mentioned you could already connect it to the average demand supply curve because of net exports, right? When your currency appreciates or depreciates, that affects imports and exports, that affects aggregate demand. So this connects to my loanable funds market through capital flow. This connects to my aggregate demand and supply graph through net exports, through the currency appreciating or depreciating. And these capital flows can also be tied to questions about the current and financial account, start from the last video. Because if you're importing and exporting more or less money, cool, then your current account would be moving towards either a surplus or a deficit. If that keeps track of net exports have to do with the current account. So if we're seeing this sort of swap of money left and right, back and forth, then that would affect my current account as well. Some loanable funds market supply increase showed you that. So here is one final example, some like sort of half of an FRQ effectively. So here is your question. Japanese firms increase imports of American-made batteries. This is a three-part question. Go through the entire thing. Practice drawing it. Okay, practice drawing your Forex market graphs. Again, draw both. They are typically a good idea to draw the two currencies. A question might only ask you to draw one. It's generally a good idea to draw both and just circle the one you want them to actually grade. So go through this problem for me. Okay, so me going through it. And I'm going to have a knock on my door at some point in this video, so just disregard that. Okay, Japanese firms increase imports of American-made batteries as an immediate result. The current account moves towards, okay, so Japan is importing more American goods, so America would be exporting more. If we're exporting more, that's a good thing. We're moving towards a surplus. So it'd be a surplus here. And net exports will do what? Well, we're exporting more, so net exports are increasing. So that's my first starting point. I've got a surplus, I've got more net exports. Great. Second thing, graph the change in exchange rates of the US dollar and the Japanese yen. Label your graphs correctly. So I need to have a dollar graph and a yen graph. On my dollar graph, whiteboard time. Should have grabbed that before. I'm very dumb. And now my chair is stuck on a thing. There we go. Fixed it. On my dollar graph, which is quantity of dollars and yen per dollar, on my dollar graph, They are buying more dollars. So I should, there we go. They are buying more American goods. They want more US dollars, so the demand for dollars is going up. It says to show the change in exchange rates. That would be my equal. I have to do my dotted line stuff. And the yen graph, because I should draw that too. Quantity of yen, dollars per yen would be my y-axis. Remember that your denominator will match the currency. So there's that. I've got dollars per yen as my y-axis, quantity of yen. I'm using the symbol for a yen, which is like a capital Y with 2 horizontal lines. They would be supplying more yen in that example. Greater overall supply of yen because they are exchanging more of their currency for another. And then graphically illustrate the change in the loanable funds market in the United States after the change in net exports from question 1. Okay, this is referring to capital flow. So in question 1, my net exports were increasing. So what's happening to capital flow? Where's money going? If net exports are increasing, money is flowing into the United States. Because capital flow is the flow of money. If we're exporting more, money's coming in. Again, Japan is importing American-made batteries, so America is making money. So on my loanable funds market graph, sorry, I'm drawing it. On my loanable funds market graph, I would see an increased supply of loanable funds. Because now we've got more money flowing into our economy. The one thing to be very careful about when it comes to this loanable funds market graph stuff is what part of the question are they asking about for this? Because we mentioned, when your currency changes value, that does affect imports and exports. So like in this example, if you look, we have this initial increase in net exports. But if I look at my number 2, my graph, my US dollar graph, I said the demand for dollars is rising, right? So the value of the dollar would be appreciating then, correct? Well, as a result of the change in the value of the currency, which is that it's appreciating, if the US dollar is appreciating, then we'd be importing more and exporting less. Currency appreciating causes net exports to start to fall. So this question had instead asked, draw a loanable funds market graph after the change in net exports as a result of the change in the value of the currency, which I think I have like this on the next question. Based on the depreciation or depreciation of the dollar, then I've got to think, okay, wait, US dollar appreciated there, imports are going up, exports are going down, so capital will actually start flowing out of the United States and the supply of loanable funds will start to decrease. Oh, yeah, you've got to be very careful, and just what I would tell you is don't stop thinking. Don't stop thinking on these. Keep thinking. Don't be like, I got it, it's done. It's like, no, think. What did the question ask you to do? Question asked based on the exports from question 1. Okay, I'm going up there. And exports increased. Can go off of that. We're exporting more. We're making more money. Loanable funds supply should go up. It's a supply shifter on loanable funds graph for this. I'm not changing the demand for loanable funds here. On the second one, which pause, I'll do it really fast. Go through the second one, and then we're done. Pause, go through it real fast. I'll go through it, and I'll go over it really fast. Okay, we develop an interest in Chinese cars. We would move towards a deficit because we'd be importing, and net exports will decrease. We would be demanding more yuan. That's how you pronounce that, but it's not really good at pronunciation. And supplying more dollars. There'd be a greater demand for the Chinese currency, a greater supply of the U.S. currency. It says based off the change to net exports caused by the appreciation or depreciation of the dollar, which is that the dollar depreciated, so net exports would be going up. So if our currency is worth less, we can export more, then the supply of loanable funds would go up on that drawing. So be careful. For when they're asking about the loanable funds market graph, they'll be asking about capital flow, but capital flows different directions in different parts of the question. Initially, it flowed out of the United States, but eventually, because the economy has that whole like self-correcting bit, eventually it did flow back in because of our currency value changing. Okay, that is it for the foreign exchange market. That's not what I want to hit. That's what I want to hit. Default with bigger camera. That is it for the foreign exchange market. There is no long run component. There are only really 2 shifters. The shifters are a change in your desire for foreign goods, which could be because you actually just like the good more, because of price level, because of GDP, could be a couple things. The second shifter is interest rates. And remember, you will be chasing the high interest rate in the foreign exchange market. I can't avoid the glare here. I'm like getting a glare blasted because doing this at noon. So you can't avoid interest rates on this one. You're going to want to go to where there's a higher interest rate. The second step is knowing how to graph it, where we have you're going to draw usually two graphs, one for each currency in the problem. On one graph, demand will be changing. On the other graph, supply will be changing, but they will be changing in the same direction. So if you can figure out that like the demand for yen will go up, then the supply of the other currency will go up. That's the door. That's my dog barking at the door. Give me 1 second on that. That's the big thing to review. Check the graph, check appreciation, depreciation of currency, what happens to net exports, and then check capital flow and how it affects the Loanable Funds Market, and you'll be good for this. Thank you guys for watching. I'll record another video for my kids that are remote for next week. Thank you all very much.